MBA ASAP. MBA ASAP.
Financial statement analysis, right? Now we know the different financial statements, and they're the balance sheet, the income statement, and the cash flow statement. And we know how they all interconnect and how they flow together. Now the next part is how do we analyze these statements, and how do we compare one company to another or a single company over time? How do we look at benchmarking, an industry to see if we're performing as our company better or worse than the industry? The way that we do those kind of things is with financial statement analysis. And there's two basic ways that happens. And this is basically where finance and accounting kind of overlap. So this is, the next class is going to be in accounting, and then there's a finance class that comes on later. And as we talked about, accounting is sort of retrospective. We're looking back in time at what happened in the past and measuring those things. Finance, a big part of it is looking into the future and projecting, making financial projections about what's going to happen in the future, and then seeing if we hit those goals that we then set for ourselves as a company. So the financial statements are right in the middle, basically talking about what's happening right now. So there's two kinds of analysis. One is vertical analysis, where you're looking at one company just across a couple of performance things, maybe one number from the balance sheet, one number from the income statement. It might be two numbers from the income statement, two numbers from the balance sheet. And the other way is horizontal, where we're looking over time, where we're looking at, did revenues grow, did net income grow, did expenses go down or up? Those kind of, is inventory going up or down? Those kind of different things. And then benchmarking is where we take those kind of results, say for an industry, and come up with an average and say, okay, here's where we should be on our percentage of earnings relative to percentage of revenues, or here's where inventory turnover is for the industry, or accounts receivable collecting and things like that. And the reason that we do them as ratios is because ratios take out the size difference between companies. So you can compare McDonald's to one little hamburger stand and say, how do we compare, our little hamburger stand? How does Sonic, or how does, Griff's up on Central compare with McDonald's? Are they, are we making as many hamburgers? Are we making as much profit? All those kind of ideas. And you can do that with just having the financial statements and doing the ratios. And a ratio, let's start with that. A ratio is basically two numbers, right? And it can be also expressed as a percentage. But it can be expressed as two numbers. There's the numerator that goes on top, right, and the denominator on the bottom. So you're dividing one number by the other, and that takes out the size difference. That does what they call normalizing the numbers. So you can compare apples to apples, is the phrase, So that's and then if you do it this way as a fraction, you can show that as a percentage, right? So if this is 1 over 10, say, then that's the same as 10%, right? 1 over 5 is the same as 20%. So you see ratios done both different ways. So the kind of financial, there's fundamental analysis where we're looking at the numbers, and there's financial ratios, and we're also going to talk about DuPont analysis, which was started by the DuPont company, a big chemical company in the 1920s, as a way to take apart the drivers of return on equity, and return on equity is one of these performance ratios. How much money are you getting back on the shareholders' equity? So return on equity basically is net income, right? And that's the bottom line of the income statement, divided by equity, which is the equity on the balance sheet. So here we're taking one number from the income statement and comparing it to a number on the balance sheet. And that's the number that a lot of people use. What's the ROE? Another one is ROI, return on investment. Same kind of thing. And this is also how, one of the fundamental concepts for valuation. So the history of this, we talked about this a bit, but back, there was a stock market, the big cataclysmic event that started all of this reporting and financial statements in the United States was the stock market crash of 1929. Stock market crashed, suddenly everybody realized the value that they thought was there wasn't, and they all tried to sell their stocks at the same time, and the market value of them all went down. A lot of banks had those stocks as assets on their balance sheets. That meant their balance sheets shrunk and their liabilities stayed the same, so their equity went away. The banks all folded over the next couple of years. So Roosevelt came in as president in 1932, wanted to fix this, right? And part of what he wanted to fix was bring back confidence into the markets so that people would be willing to put their money and invest and not think it was a con game. So what he decided to do, what they did was they made the Securities and Exchange Commission, a government regulatory group that would oversee the stock markets. Every company that was going to be on the stock markets, they made rules in 1933 and 1934. And those two rules created the SEC. So they wanted to bring confidence back. One of the things they said was every company that's going to be publicly traded is going to have to report audited financials. They're going to have auditors come in, look at their books and say, okay, that balance sheet, that income statement, and that cash flow statement reflect the business, and now you have to show that to the public so every investor can see it and see if they want to invest or if they want to stay in the company. And he got Joseph Kennedy to run the SEC, to be the first runner of the SEC, because Joseph Kennedy, John F. Kennedy's, President Kennedy's father, was a brilliant stock manipulator. So he knew all the tricks and all the shenanigans of how to get around it. So who better to try to shore up those kind of loopholes than somebody who really knew how to use them, right? Kind of interesting. So that's kind of the history of it. So suddenly we had these financial statements, and then a fellow named Graham, who was a professor at Columbia Business School, wrote a book on value investing and how to do this kind of financial analysis to see if you should invest in the stock of these companies, which are the best ones. And that book wouldn't have made sense before 1934 because companies weren't mandated to do this, and nobody did it. And if they did it, they'd manipulate the books to make them look good. So the first copy of that book came out, I think, in 1936, and it's been editions of it ever since. It's still the Bible of investing. Graham and Dodd was his partner in it after a while. Graham and Dodd's Value Investing, or The Intelligent Investor, it's called too. So let's get into financial ratios. So there's a couple of different kinds, right? The first kind is, there's four main categories of financial ratios. There's liquidity ratios, and there's profitability ratios, there's activity ratios, and leverage ratios. So those are the various ones. Liquidity and solvency ratios are, does the company have the amount of money on hand to pay its bills? So we talked about the liquidity ratios, and solvency is basically, does it have more long-term ability to pay its bills? How is financed that way? And it's all about what are the risks of bankruptcy? What are the risks of the company going out of business? Bankers are very interested in these kind of liquidity and solvency ratios because they want to make sure that the company has a good chance of being around for 10 years if we're going to lend them money for 10 years. So they're going to, when they do their credit analysis, going to look deeply at these ratios. Big customers, if you're going to buy something, and you're a big customer saying you're gonna buy $1 million equipment from a company, you want to make sure that that company looks pretty good, that they're going to be around in 5 or 10 years to service the equipment you bought from them, right? Same thing with a car company or something. You don't want to buy a car and then 2 months later the car company goes out of business and you're stuck with something that you can't use. So smart customers will look at and analyze a company too to make sure it's going to be around. And these are the measures of longevity, how long the company is going to be around for. And it has to do with basically comparing the asset side of the balance sheet to the liability side of the balance sheet. The main ratio, the main liquidity ratios, there's two, but the current ratio is you look at current assets relative to current liabilities, right? And is current assets bigger than current liabilities? And current assets is all the stuff that can be turned into cash within the next year, ostensibly. So that includes cash, that's the major thing. Accounts receivable, and a lot of times you'll discount some of that for some bad receivables to make sure that what you're going to get is actually the cash. And then inventory is in there as well with the current ratio. And that's, on the top as the numerator, the denominator is your current liabilities. And if this number is bigger than 1, you're in relatively good shape. And then if it gets higher, if it's bigger than 2, you're in really good shape, and things like that. The quick ratio is the same kind of ratio, but it takes out inventory. So it's all your current assets minus inventories divided by your current liabilities. And they also call that the acid test ratio. It's like, because trying to change inventory into cash quickly can be very difficult. You probably have to sell it at a fire sale or a very big discount, and then you might not have enough. If you're counting on that money to pay your current bills, you might not have enough money to pay them. So then you have the solvency ratios, and what they are is looking at your assets, actually basically your income, and then adding back your non-cash expenses, right? So where does that come from? That's the first part of our cash flow statement, right? We take net income and we add back and subtract all the things from operations, right? And then this number here has the net income plus all the non-cash expenses and additions from operations. This number here then is the number that becomes the numerator in this effect, and then on the denominator is your short-term liabilities and plus your long-term liabilities. And that's the solvency ratio. Are you making enough money to cover those going forward into the future? So then we get into profitability ratios, right? And that's how profitable you are. A lot of profitability ratios might be, one of them might be on the income statement, right? Your revenue minus expenses equal net income. Well, what is the percentage? How many expenses do you have? And one way you can look at that is, what's the percentage of net income to revenue? So if you have net income over revenue, and say, in businesses like Apple or these businesses that have high margins, high margins means you don't have much in expenses relative to net income. This might be 40%. 40% of the money might fall to the bottom line. But in a grocery store or something like that, these margins might be incredibly skinny. It might be most of the money is taken up in the cost of the goods, the real estate, the employees and all that, and the net income over revenues, the profitability might be 2%, right? And this might be a huge volume. You're doing so much volume that it becomes big money anyway, even though this is a small amount, net income's a small amount of the revenue. So you want to look at that to see what the dynamics of the business are. There's other ones too. Return on equity. We talked about that just before. Net income divided by average shareholders' equity. And what they mean by average shareholders' equity is you take the equity at the beginning of the period and then the equity at the end of the period, those two balance sheets, and you add those together and divide by 2, and that gives you the average. So that's, you want to look at the average in a number of these cases. And then earnings per share is how much of this net income is allocated to each share of stock. You might have 1 million shares of stock outstanding, right? So if you have a million shares of stock outstanding and each one of those is an owner of the company, right? And you make $1 million in net income, then that means that each share of stock gets $1 of that net income. So that would be the earnings per share, right? So it would be $1 in that case. Sometimes it's 40 cents, sometimes it's $2.50. And then depending on that, you can have something called the price-earnings ratio, and that is the price of the stock divided by the earnings, and that tells you if it's how good of a bargain the company is. If the price earnings is low, that means you're getting a lot of earnings for a low price, right? If the price earnings is high, that means you're getting a little earnings for a high price. And the reason companies would be like that is if people thought that in the future this company is just going to have tons of growth potential. Like price earnings ratios would be very high for like Google or Amazon or a company where they think all of the future is going to be much more upside. Companies that are more mature and not going to grow as fast, the price earnings is lower. And you can look up the PE ratio on Yahoo Finance or Google Finance or in the Wall Street Journal, New York Times, all that kind of stuff, and see that and compare them. And so you can make decisions about where to invest or where your company sits. So activity ratios, these are the ratios that see how the management is doing, right? How the business is actually doing. And this is where management has the most control. So accounts receivable turnover, right? That's how many times, how quickly you're getting in those accounts receivable. Like Carrie, you were talking about, are they going to pay? Well, you look at your accounts receivable, and in your accounting, you will have aging of receivables, right? So who's paid in 30 days? How many are outstanding 60 days? How many are outstanding 90 days? The further out they get, the less likely that somebody's going to pay. And usually the ones that are 90 days out or 60 days out, you have somebody that manages receivables, gets on the phone and call them up and say, hey, we noticed you haven't paid your bill, just checking up. That's where you always get the old saying, the check's in the mail, right? They'll say, oh yeah, the check's in the mail, yeah. And then you don't get it, right? So you want to be turning that receivables very fast. If you keep your receivables, say on average your receivables are 30 days, right? On an annual basis, that means you would turn your receivables 12 times, right? Every month you'd be turning. If it was 60 days, then your accounts receivable turnover would be 6 times, right? So that's basically how you do that. And that turnover ratio, the way you do it is the average accounts receivable. So that's the AR line right under cash, right on your balance sheet. And it's the average, so you take the one at the beginning of the year, the one at the end of the year, add them together, divide by 2, get the average, right? And that's on the bottom, that's the numerator, and on the top is your total credit sales. And so that'll tell you how you do it. And then the average collection period is 365 divided by that turnover ratio. Or the way that I just said it, where you just, if you know how many days on average, then you can just divide it by 365 is how many days in a year. So that's one performance thing. The other one that's really important is inventory turnover. How often are you selling that inventory? You don't want to have inventory that's languishing around. You want it to be sold. You want it to be moving. You want to have popular products that are just moving out the door as fast as you can make them and not sitting in inventory forever, right? So that again is the total sales, either your total annual sales or your cost of goods sold, right? We looked at that on the income statement. The first line to get to your operating profit is revenue minus COGS, right? Gives you your operating profit, and then you take out SG&A, and then you get to your net income, or your EBIT, right? Your earnings before interest and taxes. So basically, this number is a more accurate way to look at inventory turnover because that's actually the amount of cost relative to that inventory. But different companies use different, either number, sales or COGS to do that. And then you look at your average, divide it by your average inventory. So there's lots of activity ratios, but those are the most important ones. And you're looking at how the company is performing and how management is performing, because this is where management can really make a difference, right? You want to get those receivables in. You may want to hold off your payables a little bit. And so that way you're getting sort of a loan from the people you have to pay, because what they call that is using the float, where you float between where you owe people money, where they give you the bill, and then you might extend it 60 days or 45 days before you put the cash out the door, and they're giving you basically a short-term loan. And that can help with your line of credit, type of things too, because you can pay your short-term, other expenses you have to pay, like salaries, and maybe hold off some of your other payables a little bit and use that money to fund it. That gets kind of dicey, but believe me, companies, you got to do that stuff sometimes to make ends meet, right? Leverage ratios are basically looking at the right-hand side of the balance sheet, liabilities and equity, right? Your assets are funded with debt, borrowing, and money that you put in, right? Equity. And so your leverage ratios are how much debt you have to how much equity. Sometimes they call it the debt to equity ratio. Sometimes they call it just your leverage ratios. But that's basically what it is. You're seeing if you have a lot of debt to equity. Many companies have maybe 8 times as much debt as they do equity. That can get kind of scary. You start looking at a company and seeing how much debt they have, how much equity they have. That shows you how much of a cushion they have if their assets fluctuate in value, right? You want to see a company that has startups. If you're starting up a company, entrepreneurs, a lot of times people say, oh, I'm starting up a company, but the bank won't lend me any money. I don't understand. Well, it's because you don't have any assets, first of all. You have no credit history to see you're going to pay it back. And whatever you're doing can fluctuate so much on the left-hand side and the asset side that you usually have to always start startups with just equity. And that's where venture capitalists, angel investors, those kind of people, they're buying equity. They're buying this ownership thing. After a while, after a company's going and you have stable markets and all, then you can go and buy, get some debt. A lot of companies that put up that have high debt to equity ratios might be, say, like a utility, where people are going to buy the electricity and you have historical records of how many households and they're going to buy it. So you can load up the debt and know you're going to be able to service that debt, because short of, a power, your power plant breaking or something, you're going to get the revenues to service that debt. So it's companies with more predictable revenue streams can take on more debt. And then a lot of companies you want to leverage, they call it leverage like a lever, right? Because that is leveraging the money that then can flow to equity. Because debt has a fixed repayment, like 10% or whatever the interest rate is. Any other money you make in revenue, if you boost up revenues, the rest of that money that falls to the bottom line goes right into retained earnings and goes to equity and goes to the owners, the shareholders. So DuPont analysis. This was developed by the DuPont Corporation, which was a big, it's a very big chemical company and a big conglomerate. But back in the day, they were really innovative in a lot of ways financially, and they came up with this tool to take apart, to deconstruct return on equity, and what drives return on equity. And they realized in their business that there was 3 drivers of return on equity. And it was profitability, and that's the profit margin, right? That's this part here. How profitable are you? How much of this net income relative to revenues are you making? Is it really high or is it really low? So that's one of the things on there, right? The profit margin. Asset turnover, how quickly are you turning over your inventory, your assets? And then an equity multiplier, and that's that debt to equity ratio. How much leverage do you have? So they came up, if you put those 3 things together and multiply them together, then you come up with your return on equity, which is net income divided by equity, right? So really interesting way to go about and look at that. And so, yeah, the profit margin is your net income divided by sales, right? And your asset turnover is sales divided by your assets. And so that's how efficient your assets are, how profitable they are, how effective they are in creating sales, right? Because at the end of the day, all of these assets are income generating assets. So how much income are they generating? And then the other one is your assets divided by equity, your equity multiplier. So those are the three things in the DuPont analysis, and so that's a great way to look at a business too. You can take your income, your financial statements and start doing these kind of little ratios and check out, see how you're performing, what's going on, see how these different drivers are working. So working capital, that's another phrase we hear a lot, right? Working capital. Working capital is where another area where management really has a lot of influence and can perform and make stuff happen. So move this a little bit this down. So the three things that working capital is basically, it's something similar to the current ratio, right? It's current assets and current liabilities is what we're looking at. But instead of dividing one by the other, we're subtracting one for the other. Working capital is current assets minus current liabilities. So it's how much money do we have to fund to make the company run on a short-term basis. And the three things that do that are, the three big areas where management has a lot of control and influence, a direct impact, is accounts receivable, right? If you can get those accounts receivable in faster, you're turning it into cash. That's helping to fund your working capital. If you can turn over that inventory faster, that's, if you're managing inventory better, then that is funding your working capital. And your accounts payable, that's a current liability, right? If you can push off or manage your accounts payable better, then that'll also fund, as I was saying about you getting kind of a loan from your people that you owe money to. So that's how you can think about working capital and how you can manage working capital. You want to do, have products with short life cycles so that you're getting them out the door quickly. You don't want to have. That's one thing you want to look at a company over time is, are they building up inventory? That could be a signal that the company's having problems. And where can you find financial statements to analyze? Well, the best place is sec.gov. Go to that website, go to the Edgar part of that electronic data gathering and retrieval, and you can just look up any company, any public company, and you can look at their latest 10K and look at their financials and check them out and start doing some of this analysis, and then you can see whether that's basically what Warren Buffett does all day long, and all of these big time investors is just read 10Ks and find out what companies are doing well, what companies have maybe assets that are undervalued on their books, what companies have good prospects, what companies are well managed, or vice versa, what companies are poorly managed, or what companies look like they might have a buildup of inventory. That might be a flag to not invest in that company, or if you are invested in that company, to sell and invest in another company. So, and then you can also use those publicly available financial statements and look at in your industry segment and maybe look at half a dozen of them or so and come up with an average of those and use those as a benchmark to benchmark the performance of your company. And see, well, yeah, we're doing pretty good, or geez, these other companies that are public are just, really outperforming us by a lot. Why is that? And start looking into that and see where you can perform better. It's a good way to sort of measure your performance. So that's it. Any big questions or little questions? Anything? Okay.
MBA ASAP. MBA ASAP.